So let me just hit on the top three things before we hop into the call. So again, the sort of the headline here is that the macro pain trade is on. No matter how you slice and dice it quantitatively, we're basically at max pain for a lot of these sort of consensus macro positions, including some of our own. With number one being the euro, big multi-standard deviation move in the euro USD. It's back up to $1.12 now, and that's all the way from $1.05, which was, if you recall, back in January, that was our target. Heading into the beginning of this year. And so that's one heck of a bounce. And then obviously European stocks don't like that. They did not enjoy that. And we really doubt Draghi's going to sit on his hands and watch idly by as he starts to lose or win, but lose the currency war by allowing his currency to appreciate from here, given some of the growth and inflation headwinds we've seen in the Eurozone that caused him to implement LSAP in the beginning of January in the first place. Number two, the 10-year bond yield in the U.S. Also got a big multi-standard deviation move in that as well. So you're definitely testing the patience of a lot of these positions, and to some degree, certainly a lot of traders are being agitated just based on a lot of these multi-standard deviation moves. If you think about German bond yields, they doubled off their all-time lows. There's definitely some impact in the rates market just based on what we've seen policy divergence in the last sort of day or two. So, but like we're seeing in the foreign exchange market, the risk ranges for a lot of these sovereign interest rates are actually widening, and what that typically does is it usually is a leading indicator for rising implied volatility on a trending basis. So if you take that across the FX market and the fixed income market and say, well, our leading indicators for implied volatility in both of these markets are rising, you can sort of make the case for a sell the man go away experience, or at least a strategy, just based on our expectations for volatility to continue rising from here. And then lastly, the Russell 2000. So in so much as European stocks really don't like the up euro, US growth stocks don't like the down dollar, because that obviously does what? Gives you rising gas prices, rising commodity prices. It stops the disinflationary tailwinds we've seen in U.S. consumption growth. That was actually quite good in the fourth quarter, slowed in the first quarter, obviously, but it actually slowed a little bit in the fourth quarter on a sequential basis, but obviously 10-year highs on a year-over-year basis, which is something we called out ahead of time. And so again, we're now starting to see the first immediate term trade breakdown in the Russell 2000 that we've seen in all of 2015. Recall that we've liked the Russell on the long side, particularly relative to its larger cap, more internationally focused peers in the S&P 500. But again, we wouldn't buy the dip here either if it's breaking down in trade and the dollar's going down. We definitely don't think that the fundamental narrative is as supportive as it has been really throughout the year to date, particularly as we head into Quad 4 and potentially into Quad 3 as we progress through the year.